You're listening to the Goldnomics podcast, with new episodes every month on iTunes, YouTube, and SoundCloud. Subscribe to stay informed. Hello and welcome to episode 4 of the Goldnomics podcast, where we look at developments in global markets through the lens of precious metals. And I'd like to remind everybody to subscribe to podcasts on iTunes, on SoundCloud, and on YouTube. And also you can check us out on GoldCore.com. And once again this month, I am joined by CEO of GoldCore, Stephen Flood.
Hello, everybody.
And Director of Research and renowned, well-known world precious metals expert, Marco Byrne.
Hi, Dave, and hello, guys and girls.
Now, gents, the topic for conversation this month is not all gold is equal. And that came from our last podcast. And it was a phrase that you dropped into the conversation last time, Steve, that not all gold is equal. So what did you actually mean by that?
Well, I think when you speak to as many clients as we do over as long a time as we have, you really drill down into the motivations of owning gold and what it is that what gold is that makes it attractive for people. It really comes down to the tangibility of gold for most. And when you're buying gold, you have to look at each option in terms of the tangibility of what you're buying at the end of the day, because the value of gold is based in its tangibility. And if you buy something that's intangible, such as a futures contract or something like that, that you most of the time you won't be able to take delivery of that in any real terms, then you have to question whether that's appropriate in a portfolio. So look at the options that are available to you, and there's a whole different set of properties that govern each one, in terms of cost, in terms of optionality, in terms of duration, the type of storage, the location. So when you look at that, look at the distance that gold is from you legally and physically.
Right.
So that's really what it comes down to. Not all gold is equal.
Right. Okay. I suppose, Mark, there are so many different ways in which somebody can buy or invest in gold or speculate in gold. Have you a framework for people to understand the various different ways in which they can invest in gold?
We do indeed, yeah. And the way we've looked at it over the years is what we call proximity to gold. So how close you are to your gold. The client comes first, and then we look all the way out the spectrum from the safest way to own gold to the less safe and more risky and more volatile ways. So the safest way is obviously you have it in your hand, in your personal possession. Generally, it's the safest way. We'll qualify that now. Obviously, there are important caveats in that regard. Then the next safest way when you move out is allocated and segregated. The next level of safety is allocated gold that you would have with, say, a digital gold provider. And there's government certificates, allocated gold certificates. And then there's bullion bank allocated gold. So that's right. your gold in the bank. Then you move out again, you're into unallocated gold, which is and the various ways of owning unallocated gold. And then you're into exchange traded funds. There's physically backed exchange traded funds and non-physically backed exchange traded funds. And obviously the physically backed are more safe in that regard. And then you go into gold mining shares, which are much, much more volatile and actually more equity rather than gold per se. And then you have crypto gold. We have all these so-called cryptocurrencies that are backed by bullion, are allegedly backed by gold these days. And then you go into the very, very highly speculative side of things, which is CFDs and spread betting.
Right.
So that's the lens why we look at it.
So when
at each step, you're getting further away from the tangibility, as Stephen said.
So the tangibility and the proximity. So obviously the closer the proximity, so the closest that you can actually be is when you're actually holding it. You have it in your hand. You have it in your possession.
Exactly.
And do a lot of your clients actually do that? Do they actually take delivery of gold coins and bars?
They do, yeah. Quite a large amount of them, and a lot would actually do both, and we encourage them to do both. But you have to feel very safe in your own home, and it's not for everybody, It's for people who they're concerned about these risks, real systemic risks that we might get into in a little while, and they just want to take some chips off the table and to actually have it in their hand. Possession is 9/10 of the law, and by taking delivery, you're really making a statement that you are quite concerned about these risks,
But are we talking about these large kind of James Bond style Goldfinger bars, or what are we talking about?
No, but the people take delivery would generally take delivery of small coins and bars. 1 ounce formats would be the most popular.
Right.
I have one here. Just I keep in my pocket. It's not gold. Obviously, I'm not carrying €1,000 around in my pocket. It's a silver coin, which would be worth about $17 today at these depressed silver prices.
Wow. Okay. So I've got a coin that Mark has just given to me here, and I'd say it's probably about an inch and a half, maybe wide. And you really get a sense of the weight of that when you put it in your hand, don't you?
Yeah, absolutely. And it's funny when clients come in and we're talking to them, and it's sometimes you can talk and talk and talk, but it's only when people have it in their hand, particularly gold, but also silver, that people get a real sense. There's almost a light bulb moment. You can see this sort of eureka moment. It's ka-ching. They sort of go, wow, now I get it. This is sort of, it's real wealth, it's real money. It's sort of condensed energy, you know, and it really does when people's eyes light up, and even the sound of sometimes if you drop a coin on a table, more gold again than silver. Yeah, there's a certain ka-ching, there's a certain energy and vibration that comes off the silver coins, particularly gold coins, you know.
And what coin do I have in my hand at this moment in time? This looks quite intricate.
That's it, yes, Silver Eagle from the US Mint.
Wow, okay.
So it's 1 ounce of pure gold, 9999 pure.
Right.
Sorry, pure silver.
Pure silver, okay. Yeah. Indeed. Yeah. And okay, so that's the closest that you're going to be to your gold or your silver. I suppose, put these things in perspective, what's the furthest distance then? What's on the other end of the scale, Steve?
Yeah, I think for the furthest from most people and most owners of gold is probably the ETFs.
Right.
Because the vast majority
of investors,
the vast majority of investors own gold in that format.
Okay, and ETFs, exchange traded funds.
Yeah, so basically it's an instrument that trades on the stock market. It's got a ticker. You can buy and sell it very cheaply. Your broker can do that for you. You can do it online. It's a great way of owning gold for most investors. But the issue many people have with it is it's not really designed for physical delivery. And ultimately, when you have gold, you have it for those very, very rare events when, you know, economies break down, governments break down, and your currency comes under risk, and you want to protect your family with a hard asset that is tangible because of, you know, not only what it is but what it isn't. It's not related to the bank, it's not related to the system, it's something you can take out of the system. So the idea of having gold in a systemically linked instrument like that can be very convenient in normal times when, you know, everything's fine and dandy. But when things get out of hand and you go into, you know, 2 and 3 standard deviations in terms of stock market, you know, moving up and down, suddenly those contracts don't really bear any weight. They don't as Alan Greenspan once said, you know, gold in extremis is trusted by everybody as a form of payment, and it's absolutely true. So when you have physical gold sitting in a vault that's available for delivery, or even to yourself or to somebody else, you're always going to have an audience, a market for that particular product. Whereas if you're in an extreme circumstance in the market and you have an ETF, you may not be able to trade that. The platform may not be open. The market may not be functioning. It may have been shut by the stock exchange.
That happened during the crisis. They became illiquid.
Yeah. So suddenly your market becomes completely dysfunctional. And you know, if you think about it, you own gold because of its tangibility. That's where its value comes from. If you own it as an ETF, suddenly you're not able to actually execute in those times when you really need it. One more thing is, when you look at ETFs and you look at the promoters of them, in many cases, and not in all, there are some good ones out there, but in many cases, and some of the most popular ones, there's an awful lot of indemnifications in those actual contracts that you sign up to automatically when you buy. And that means that if anything should happen to the system, to the people who operate it, to, you know, theft or, you know, even complete incompetence, the promoters are completely indemnified or protected from the investor. The investor has no recourse. And you know, again, this goes right against the whole purpose and motivation for owning gold.
So what do I actually own when I own an ETF?
Well, it's a promise, you know, to deliver a value in terms of an underlying asset. So, you know, typically they're held in a trust, and the trust has its core asset.
Exactly. Legally, it's a trust fund. It has shares in a trust fund.
And then the shares of that trust fund trade on the markets. And you have a market maker who is and a promoter who is balancing the books. They're buying the stock of gold underneath to underpin the value of that ETF. But the most important thing is the ownership of the gold versus the ownership of the shares. There's a disconnect. It doesn't transmit all of the properties of gold ownership through to the shareholder, because you're giving up for that convenience of buying and selling on a platform with just a click of a button. You're giving up an awful lot of properties of gold. And that works again in normal times, but not in extreme times.
And just on that, Stephen mentioned the indemnifications, and the level of indemnification is huge. And when you read the prospectus and you have to drill down into the small print, they have indemnified themselves from all sorts of things. Many of the reasons that you would actually own gold for, the specific reason that you own gold is to hedge yourself from some of these risks in terms of bank failure being a big one, So you're actually, these providers, they've indemnified themselves from the risks. And not only that, your gold is actually stored with big banks. So the custodians and indeed the sub-custodians are large banks. And we saw what happened with Bear Stearns. We saw what happened with Northern Rock and with Lehman Brothers. In this world of today, with huge debt levels across the entire financial system and in the banks, it doesn't really make sense. If you're trying to protect yourself from these financial risks and monetary risks, why would you leave your gold in these banks and own gold in this sort of proxy trust fund?
So we've talked in the last couple of episodes about the reasons for owning gold. And so what you're kind of alluding to here is that if you're buying gold for those reasons, if you start going down the ETF route, you're potentially inviting more risk into your portfolio.
Absolutely, yeah. And you're not hedging these risks. And they're a great way to and we say this to clients, when we used to, in our wealth management portfolios, we used to have some exchange traded funds, So we're not anti them per se for the sake of being anti them. We just think it depends on what Stephen alluded at the start of the conversation. It's your motivation. If you are taking a punt on gold for 6 months and you think, I think the gold price is going to go really high in 6 months, 9 months, 7 months time, or you think it's going to go lower, you can go long and short these instruments. And they're quite a low risk way to do that because you're not engaging with a huge amount of leverage, and they're much less risky than CFDs or spread betting or indeed many mining shares.
Okay, all right, Jens, correct me if I'm wrong here then. Another great way to get exposure to gold is through gold mining stocks. How does that fit into my portfolio? Am I actually getting the same hedging quality if I load up on gold mining stocks in my portfolio?
Well, yes and no.
Right.
It's very different. Obviously, you're buying shares in a gold mining company, and there's a huge amount of attendant risk in that. It's quite a high risk business. People don't realize how risky it is, and Mark Twain once said that a gold mine is it's a hole in the ground with a liar standing on top.
Okay.
And obviously, that's very harsh on the gold mining industry. And there's a lot of people with great integrity and some really genuine good people are in that industry. I think it gets a bad name sometimes. But when you buy a company and you buy a gold mining company, you have the risk of the management, the accountants, the geologists. I don't know if people saw the movie recently, Bre-X, wonderful movie, and you should try and see it if you get a chance. Bre-X, yes.
Bre-X.
It was about Bre-X, right? The name of the movie was
Gold.
Maybe it's just gold. Yeah. It's Matthew McConaughey.
Yeah.
And it's just a wonderful story, But what happens is frequently geologists are under pressure and they get a bit desperate and they can overestimate the amount of gold in the ground,
No,
it does happen. Amazingly, it does happen. Yeah. But it happens. Yeah, more than it should, so we say, But there's also environmental risk. There is geopolitical risk as well. So geopolitical risk actually tends to favor gold. When there's geopolitical risk in the world, it pushes the gold prices up. But if you have geopolitical risk and in a certain country they nationalize the gold mining assets, your stock can go to zero. So you have all these other risks. So in effect, it's a share. It belongs in the equity component portfolio. It doesn't belong. It's not gold. It's a totally different animal,
Okay.
And it actually is potentially introducing volatility.
It can be a leverage play on the gold price.
It can be, and it has been.
Gold, like every other market, runs in cycles. And so if you think that the trade winds are favorable towards gold and a gold exposure, then absolutely put that into the mix. Study it. Do your work on what possible gold mining companies to own. But if you're motivated by systemic risk and you want to hedge and you want a form of money, because that's what really gold is at the end of the day, and you want that in a safe place, you have to take it out of the bank system. You have to have it in a place that gives you all the optionality you need in extreme circumstances to direct that gold. either to yourself or to someone else in whatever way. If you want to buy when the market's selling, when everyone else is, when there's blood in the streets and everyone's losing their heads, and their senses, and you want to use your gold and then sell it well and get a good price and then buy these, other assets, then that's a great investment to have. It's a form of money that is incredibly valuable and has a huge market. But don't think that you're taking that hedging box for gold by owning an ETF or a gold mine or even a digital gold provider.
Right. Okay. Digital gold. So what do you mean by digital gold?
Well, one of the most popular ways for investors to buy gold these days, and it wouldn't have been there 10, 20 years ago, is the little guy can now get onto a digital gold provider, a website, and they can sign up for an account, and they can buy gold at, very, very low cost, and we measure cost in gold in terms of the percentage, which is the premium over the spot price of gold. That is the standard gold per ounce price. Okay. So gold has a spot price, and then you're buying gold.
What is that spot price? What does that mean?
So basically, it's gold for delivery over the next day or two, and it's set by the bullion banks that are buying and selling. They're duking it out every day. They're bid and offer, and the spot price is published, and that's what we trade off every single day. So it's
kind of like a wholesale price.
Yeah, it's like a wholesale price for gold. It's traded throughout the world, throughout the day, and we reference that whenever we're buying and selling. So the miner might be referencing the spot price when he's delivering his unrefined gold into the refinery, and he might pay spot minus 1 or 2% or 3%, and then the refiner sends it on to the mint, and he's selling it at spot minus 0.5%, and then the mint is selling it to the wholesaler at spot plus 1% or 2%, depending on the product, because there's an awful lot of costs in there. And then the wholesaler is selling it to the retailer for like another markup. So the premium is adjusting, and it's always referenced to the spot price, and allows the market to function very, very well and very efficiently. And the thing about the spot price and the market for gold, it's a highly liquid market. The gold market turns itself over 2 or 3 or even 4 or 5 times some years in terms of its value. So if it has 100 billion value, and it's actually far greater than that, the actual volume of transactions might be 300-400 billion every year.
Right. Okay.
So it's a multiplier, and it makes it one of the biggest, deepest markets in the world. So just to go back to digital gold providers, they provide access to gold, and it's a fantastic way to speculate on gold on a short-term basis, because you can buy cheaply and you can sell cheaply and you can store cheaply. But what you're doing is you're buying part, usually in most cases, you're buying part of a big 400-ounce bar of gold. These are the big, James Bond movie type gold bars.
Right. Okay.
And so they might have this sitting on a shelf in a vault, and they sell that 400-ounce bar to 400 different customers. They all own a little bit of that bar.
So if I buy an ounce via, say, a digital gold provider, I'm buying a portion of a bar.
Yeah, you're buying a portion of a bar, but you don't know what portion.
Who owns the rest of that bar?
Well, you'll never know. Those records are kept by the digital gold provider. So again, you're getting exposure to physical gold. That's a good thing. You're getting it at a cheap price. That's a good thing. But in extreme circumstances, you have to go through that digital gold provider to get access to your gold. You can't just take delivery. You can't have it shipped. You can't decide, digital gold provider, I don't want to sell to you today. I want to sell to some other chap because I don't like your price. You can't do that. You'd have to actually have it formatted into another, they take that 1 ounce, let's say you own 1 ounce in that bar. Mm-hmm. You'd actually say, listen, take my 1 ounce and convert it into a single ounce bar and then send it to me, and then I can send it to sell it to somebody else. Now, they'll charge you an awful lot of money to do that. It makes it very inexpensive, and nobody does it because, it's cheaper just to hold it in that big, pooled, unallocated format.
Right. Okay. And what are there other risks in terms of most of this is done on the internet? Yeah, most of these are big internet companies, and they're very, very popular, and they're well run. Most of them, they're reputable places. But we worry that if again we get into extreme circumstances, big market dislocations, something happens in the country where these guys operate, what happens if there are limitations put on what they can do? What happens to your gold? There are better options when it comes to owning gold for extreme circumstances, and we can talk about that in a moment. Yeah, and when you mentioned there about me owning 1 ounce of a 400-ounce bar, is that what you mean when you talk about unallocated, Mark?
Yeah, absolutely. Yeah. Well, this is unallocated, whereby you own just a piece. It could be 1.2346 ounces of that large bar along with all the other investors. And the digital gold providers, in fairness, say that they allow people the option to convert it, to allocate it, and put it into a coin or bar format, and they even allow people to take delivery.
So what's that?
But it's very costly to do
then?
it, so allocated is it's you're not an unsecured creditor provider. The bullion is in your name.
Right.
But it's not segregated, so it can be in this pool with all these other investors.
Okay.
So it's difficult, while it's in your name, it's difficult to take delivery of it in any of the worst case scenarios that are potentially there, So they're great ways, again, to sort of get exposure to gold price, but you don't own the underlying physical asset. And if you try to take delivery of your golds, we have some of our clients who've actually tried to do it, and it can be a lot of barriers put in the way, shall we say, and very time consuming and quite costly as well to get it converted into actual physical coins and bars of a format that you would potentially take delivery of, So I think Stephen alludes that it's the geographic risk as well. Some of the providers, say it's a country, X country that has a lot of debt, and this is it's a company in this one country. If in the worst case scenario this highly indebted country gets into a lot of financial difficulty and they don't have very large gold reserves, they could potentially nationalize that company.
Right.
So what we have done in GoldCore is we've actually set up whereby all the clients' gold is stored in very safe jurisdictions internationally, and that way you're lessening your geographic risk, which is something important that we should talk about as well. Yeah.
So you store it in safe jurisdictions, in non-bank vaults, in segregated format. So it is held separately.
Segregated. Yeah, talk to me more about that when you say segregated.
In the glossary of gold terms, segregated, allocated, unallocated are really important concepts. Basically, and Marx has alluded to what unallocated is. You own an interest in a stock of gold. That, with the physical format, it's not defined. Okay, allocated is defined, but it's part of a set of defined bars. So you own one bar of 10 bars. Segregated is where that one bar you own is put in a separate storage location. It's put in a box on a shelf with your name on it or your number on it, and it gathers dust until you say otherwise. You can visit the vault, have that brought out to you. You can kick it. It's your bar. You can scratch it and see a number on it, record that, come back 10 years. It's the exact same bar, physically yours. It's not one of 10. It is the one that you own.
Okay. And talk to me more about the storage side of things. So the closest proximity that we have is actually taking physical delivery, like these coins you were showing me a minute ago. And then storage. You guys, for a lot of your clients, actually, they opt to store their gold.
Yeah.
Talk to me. How is that stored? Where is that stored?
So we give people a lot of different options.
Do you store it yourself? Or,
yeah.
Or is there somebody else that stores it for you?
No. So basically, and this is that's a really, really good point. When you buy gold off a gold dealer, there's some great options out there. A lot of good guys. It's important that you store it with a company that maybe if they operate a storage facility, that the facility itself is operated by a separate company.
Right.
Now, so in our case, we use Loomis and we use Brinks. And so they do the physical storage of the gold for GoldCore and its clients.
Why is that important?
Well, because and it's critical because if I was not trustworthy, I could tell you that I sold you a bar. I could then store that bar and say that that's your bar, but I could also tell 10 other people that bar is also theirs. So there's a chance that
potential conflict of interest.
There's a conflict of interest, and you in this situation you want to have a demarcation of key roles and functions. And so in any financial services industry, and the regulators will tell you this, it's important that you segregate out the key functions.
Firewalls.
You put firewalls, Chinese walls, but I don't agree with that. I think the key functions should be operated by separate companies. And so GoldCore oversees and manages and administers the actual storage system. But what we allow our clients to do, and I don't think there's any other dealer in the world that does this, we actually allow our clients to log in to the storage provider's website, put in their account number, they have a GoldCore, and put in their email, and they can then go and see exactly what's stored in their account number, which is recorded under their name. And basically, that allows them to validate not only what they see when they log into GoldCore that they own in terms of assets and serial bar numbers, but then to go into the vault directly and also see the exact same list, thereby doing their own reconciliation real time. Now, most of the other dealers out there, they always talk about these fancy reconciliations that they might have, and they have them up on their website, and they're very, very good, and they look very, very impressive. But what they're doing is they're showing you information from one source, from themselves. So they're aggregating information from their vaults, and they're putting it up on their site. And then they're saying, look at the list of bars we own, and look at the total amount of bars that they say we own, and look, the numbers match, therefore everything is good. But if they wanted to, and I'm not saying they do, but if they wanted to, they could tweak those numbers, they could resell those bars multiple times, and just lie about the reports that they're putting up there. It could happen, it hasn't happened, and it probably won't happen, but it could happen. So what we do is we allow them to go directly to the horse's mouth, directly into the vaulting company's website, log in and show it. And the only reason we do that and they don't do that is because all of our clients in storage are segregated. Everybody has their own sub-account. Everybody's gold is separated from everybody else's gold, and it's available for inspection whenever they want.
So when people buy physical coins and bars off you guys, they're all held in allocated, segregated accounts.
Yeah, exactly. And so what happens is, and this is the beauty of it, if in the future, if things become really messy in the markets, and the client says, "Hey, I want to sell my GoldCore. What price are you going to give me?" And I'm going to go, "Hey, the price is going to be this," and they're going to go, "I don't like that price. I think it's a terrible price."
They almost certainly won't, because it'll be very competitive. But in that worst case scenario, that they weren't happy the price.
Should that ever happen?
Exactly.
Well, you know what?
It keeps us honest.
Yeah, exactly. It keeps everyone honest, and we look at this from the client's perspective. We try to empower the client at every opportunity. So the client needs to get the best possible price, and just because he stores with us doesn't mean he should have to deal with us. So he can say, "Hey, I want that account, that gold, to be transferred tomorrow." And all they're going to do is pay for the transfer costs, the actual shipment cost of that gold, and it goes to whoever they want. Whereas if they go with a digital gold provider, they have to pay for fabrication most of the time, and then they have to direct it, and it takes weeks, or at the most days and days and days to have that happen. At which time the market could have moved. An ETF, almost all of those investors, almost all of them, can't take physical delivery of an ETF gold.
Yes, and there's huge counterparty risk with that one company, huge dependence just on one company and their management, their directors, their employees, their IT people, their servers, their websites. And you're adding a lot of risk into the mix that you don't really need. And one risk that we consider, very, very few people consider and talk about, it's what we call a single point of failure in terms of that risk. And then the other risk is the pricing risk and what we call closed loop trading, whereby when you go to sell your gold, you are completely dependent on the price that they give you on their website, and you have no choice because you are a customer of that digital gold company.
So I can't take my digital gold from one company and sell it to another company.
You can't unless you actually take physical delivery of it, and it's quite costly to do that, and the redemption fees can be quite expensive as well. So on the pricing side, there's two risks. There's a liquidity risk in terms of those problems with these companies and their technology and their websites, and then there's also the actual price that you would get, and in terms of the redemptions, but also the spreads. So in a certain scenario, a large institution or a hedge fund or a large bank could buy one of these digital gold providers, and they could say, "Oh, there's some nice juicy these clients are completely dependent on us on our pricing, so we're going to increase the spreads on both the buy side and the sell side," and you have no option but to sell through that platform.
Yeah, can you imagine a private equity guy coming in and going, "Hey, you know what, I'm going to ramp up redemptions to 20%. Remember, it happened in the pharmaceutical industry in the States. There was a case where a young fella went in.
Shkreli, wasn't it? Martin Shkreli.
Yeah, and he went in, he said overnight he ramped up the prices.
The price by 700% or something on a specific
And if you're a capitalist, you go, you know what? That's part of the game. This is what it is. He bought a company. It had these rights. People gave them to him. It's
legal. It's not fraudulent. It's totally unethical and unscrupulous. But it could happen.
So it's not beyond the realms of possibility of some sort of vulture fund coming in and taking control and then widening spreads and making it more expensive for people to deal with that.
Bank.
And again, we're not disparaging the people who run these companies. They are fantastic in most respects. They probably wouldn't want this to happen for their own reputations. But we're saying, you just don't know. So if you're going to own gold, own it in a way that allows you to direct that gold as you see fit, when you see fit.
Portable and movable.
Yeah, so let's go back to the other end of the proximity continuum, let's say. I mean, we've been talking, obviously the closest you can be is buying physical coins and bars or having physical coins and bars stored on your behalf. And we keep on saying coins and bars. Is it coins or bars? Which should I go for? Should I buy coins or should I buy bars? What's the difference between the two?
Generally, smaller investors would go with the 1 ounce coins and bars, and larger investors would tend to go for the larger bars, particularly the kilo bars and the 400 ounce bars. People who are taking delivery would tend to take delivery of the 1 ounce bars, and sometimes the British gold sovereigns, the quarter ounce, 0.2354 ounth.
So they're quite small gold coins then, a quarter ounce, yeah.
Exactly. Yeah, and but I suppose it very much depends also where you live, and people in the US would favor US mint, gold and silver eagles, the likes of which I have in my hand here. People in Europe, Austria and Germany like the Austrian Philharmonics from the Austrian mint. Canada, they like the Canadian maples. South Africans like South African Krugerrands. Most of the world likes South African Krugerrands, actually. They're quite universally popular.
Right.
And then in the UK, they have Britannias and sovereigns. And the people in the UK are very lucky. And we always tell our UK clients, and the wider UK gold market, why would you buy any form of gold except Britannias and sovereigns in allocated segregated gold ownership?
Why is that?
Because it's just an absolute no-brainer in terms of the total cost to the investor, because there's no capital gains tax.
No capital gains tax.
No CGT.
If you're a UK resident.
Exactly. Envy of the world of gold investors internationally look at that and they just go, and a lot of people they're not aware of it. It's amazing. Even sophisticated investors aren't aware of it, and it makes gold coins, Britannias and sovereigns very attractive, even to high net worth, ultra high net worth, and family offices. Because you may pay 2% premium for your gold bars, which is slightly higher than you would pay for an ETF or 400 ounce gold bars. But you're going to save, I think it's 23%. I must look at it again. I changed there recently. I think it's 23% is the CGT in the UK. So it's a huge, in terms of the round trip cost of that total investment, it's an absolute no-brainer.
Okay, talk to me about the premium, Steve.
Whenever when you buy an ETF, you could buy $100,000 worth of gold for $10, $20, whatever the trading charge is. It's really cheap to buy it. That's what makes it really attractive. And we think for speculation, there's no problem with it at all. You're buying that 1 ounce gold coin from one of the big mints, like the Royal Mint or something like that, or the Royal Canadian Mint or the US Mint. You're buying a highly formatted product that had to go through an industrial process, and that industrial process has costs. Okay, so they had to obviously refine it to a certain standard, press it, stamp it, and then design it and deliver it. And so when you buy it, you're paying spot plus a premium, and for that premium, you're getting that highly refined product.
Because this has gone from being just a hunk of metal, and I'm holding the coin in my hand again here, guys, and see if I can get away with keeping it. But it's gone from being a hunk of metal into being quite an attractive coin. I mean, there's a lot of workmanship and design and pressing, I assume, that's gone into creating this.
Yeah, and it's also the origin as well. That's come from the mint, and so it has a reputable mint behind it. You're buying that, you're trusting the mint and its good name and reputation to stand behind the production quality there. But the important thing is that when you buy that, it's going to cost you a little bit of money, that premium. But also when you sell it, some of that premium goes with it as well, so you get some of that premium back.
Okay.
So it's not fair to say that it's a one-time cost. Some of that cost actually comes back in terms of when you sell it as a percentage over premium. And if the market really takes off and those coins become very much in demand, the premium can even grow and grow and grow. So you might find that the premium to buy a gold coin goes up from maybe 4 or 5% up to 10% in those extreme market circumstances, as people really, really want that particular coin. The Krugerrands is a great example. In the last bull cycle in gold, Krugerrand premiums really blew out. Some people, might gobble up every premium they can get, and that means that in order to attract those sellers into the market, the gold market says, hey, I'll buy your Krugerrand, but not a 5% over a spot, I'll buy it at 10% over to entice you to come in.
So you can potentially, even though you've paid away a premium when you purchase the coin or the bar, you can potentially sell it back for a greater premium.
Yeah, and it's not likely, it's possible.
Right.
The other major benefit from a coin when you're buying gold is it's almost economically impossible to create a fake gold coin. Now, there are people who do it, and there are fakes out there, but they're very, very rare because the cost of producing a fake that stands up to even basic level of scrutiny is too dear and too expensive. So investors like the idea of having a gold coin, and you can get some home testing kits that look at the diameter, weight, and the balance in a coin.
Fisher, yeah,
the fish tests. Yeah, they're excellent. The fish tests, and you can contact us, and we'll send you on details. And you can test those gold coins very, very quickly within seconds, and you know that with a high degree of confidence that is a real, authentic gold coin, and anybody buying it from you will know that too.
Right. And do you have a process that you go through that ensures that the authenticity of your coins in your bars when you're selling them to clients?
The main test of authenticity is we buy directly from the major market providers, the major mints, and their dealers as well. We sell into our clients, and our clients sell back to us. And we also, most of our gold is held in secure storage, and it's held in what we call a chain of integrity. So basically, it went from the mint, and it was consigned to us, and it was then held in storage, and it's been bought and sold a few times by different clients at different times, and we know where it's been at every step in the process.
So it stays within that chain of integrity. So therefore, you can stand over it and say these are
exactly
these are authentic.
Yeah,
coins and bars.
we can show that the lifespan of that gold coin and who's owned it and at what time and when they sold it and where it's been at every step of the process. And it's very, very important that you have that.
Okay, yeah, and it means they're liquid as well. Once they go out of the chain of integrity, there has to be a verification. They have to come back in the chain of integrity before we will actually buy them from you.
Right.
So it's less liquid if you take it out. You put it into safety deposit boxes with third parties, or you take delivery of it.
Let's put this all in perspective then. Let's say, for example, I've 20,000 euros that I want to invest in gold. Can I buy 20,000 euros worth of gold?
Absolutely.
And if I can, what would I buy?
Yeah, well, there's a number of different options, and I think what you do is you take a step back and you look at, is that the right amount for you in terms of your portfolio? And many people look at around 10% allocation of their investable assets to gold, and in your case, let's say that's 20,000. So you want to first and foremost you want to take delivery of some gold. If you're able to, and you're able to do so safely, you take delivery of some gold and you take delivery of some silver. And you can get silver tubes, or let's say 25 coins, and you can have them delivered to your home. And the reason for that is, just like in investment parlance, they always suggest that you have some cash to hand, some cash. So if you lose your job in the morning or something unexpected happens, you can pay the bills for a few weeks, maybe a few months. So it's a good idea to have maybe 2 or 3 months worth of after-tax income in cash available to you at short notice, on hand or somewhere close by. And in the same reasoning, you want to have some gold and silver. And it's even more extreme that you'd need the gold and silver, because then you're looking at a case of where there's an event in the world where the currency's under attack or has collapsed or something like that, and you need to have a form of money that is superior to your normal money that you use every day, or known as fiat money. And I'll give you a scenario where that might work. Something's happened in the economy, the euro has collapsed or the dollar has collapsed or something like that, and the local shopkeeper is having a hard time processing payments. He doesn't know if he can accept the money anymore. Inflation's gone crazy. But you turn up and you give him a gold coin and you say, give me credit on this. And he's going to accept that as a form of money almost every time, because it's throughout history, it's a form of value. He can use that with his suppliers as well. And so therefore you would have access to goods and services by depositing that gold coin or that silver coin in those extreme circumstances. That it's highly unlikely, and we don't want to scaremonger, but that's why you need that physical gold delivered to your door. Now, the rest of your gold you should have stored professionally. You should store it in somewhere like Zurich, London, Hong Kong, or Singapore.
Why those places?
Or Perth. They tend to be safe jurisdictions. They tend to be, we store gold there on, as we mentioned before, segregated and allocated. So it's available for you to take delivery or go and visit and take away if you want. You can turn up the vault and have it put in the back of the car and drive away.
Oh, so I can actually go visit my gold.
Yeah. We have clients who go and visit their gold and take pictures of it, and then, and just to satisfy themselves that it is there.
A few companies that allows their clients to do that, sure.
Yeah, they go to Zurich on a regular basis, and we love that, because then they tell their friends and they go, listen, I own gold, but I own it in the right way. So that investment you could buy 1
And
ounce
could I
coins.
do that even with my 20,000 euros?
Yeah, you can go and buy a few. You could buy a monster box of silver coins, and you could buy 1 ounce gold bars or 1 ounce gold coins in a stack and have them stored there in your name.
Wow.
Yeah,
I like
you
this
can go
idea.
and visit. Very few people do, but you can, and it's very reassuring to people knowing that they can at any moment do that. So it's as you said, it's a hedge against these worst case scenarios. Particularly when you take physical possession, that's what it's there for.
Right.
It's that form of financial insurance against these worst case scenarios.
And would I buy, would I buy individual coins bars, or would I buy larger? Would I buy one bar with my 20,000, or?
Yeah, I mean, you could buy a 1,000 ounce bar of silver, which is
Right.
they're incredibly heavy. They break your back to pick them up, and you could buy one of those. It's got a serial bar number on it, and it's not very pretty. It's a pretty ugly looking thing, but it's pure silver, and it sits on a shelf. You could buy that.
Okay. And is
Yeah,
there a benefit to buying a larger denomination, or is there a benefit to
yeah.
buying smaller denominations?
It's a function of the industrial process. So if you think the amount of energy that goes into producing 1,000 ounces of silver in one single bar is a number, but the amount of energy and time that goes into producing 1,000 individual silver coins would be a much bigger number. And so that cost differential is reflected in the price or the premium that you pay. And so if you're cost conscious and you just want silver exposure or gold exposure, the bigger the format, a kilo bar of gold, it's going to cost an awful lot less than individual gold products. But the downside is you don't get divisibility. That is that you can't just sell them 1 ounce at a time. You have to sell the
Okay,
whole
I gotta
bar.
sell the whole
So
bar.
we kind of mix it up with our clients. When they come in and they're doing a significant investment, we say, right, your long term piece, let's put that in the cheapest form or format of gold we can find. In gold, maybe a kilo bar, and then a smaller amount, maybe in 1 ounce bars, and then maybe they want sovereigns delivered to their door or some silver as well.
But you actually go through with an individual client and you help them to work all of this out, because I'm quite sure there are people that are listening to this podcast. They have never invested in gold before. They don't know all the various different coins or bars or what they should do. So you and your team will speak to each individual person and try and match them then with the correct products.
Yeah, so we go through a consultation process we offer to every client. And basically, we ask them an awful lot of questions. And typically, it's about their motivations. Like, why is it that they've come today to learn about, precious metals? And we're trying to understand really what's driving them to it, and also what their perspective is in terms of what they're hoping to get out of it. And we want to guide them in a way that's going to make sure that they're going to meet those objectives over the time that they want to meet them. So, and there's lots of different options in terms of storage, in terms of product, in terms of delivery, and lots of different things. And in some cases, we tell them it's not the right thing for you. That their motivations are maybe not aligned with owning gold, and there might be other ways to think about things, and we would part company.
Okay, and I assume that people can find out a bit more on the website goldcore.com and contact you directly from there. Yes,
Absolutely.
Yeah.
Right.
And just one last thing on that. We talk about gold as a hedge and this financial insurance aspect, and it is absolutely that, and that's all the academic research, independent research, and history clearly shows that, including recent history. But it's also important from a return point of view, from an investment point of view, that gold is actually outperforming stocks and bonds over the long term. There's some great research just recently from PwC talking about how gold has returned over a 10 and 20-year period. Gold has returned 6.7 and 6.8% per annum. Stocks and bonds, as in big stock indices and bond indices, over the same period are only at 5.2%. So there's an argument. It's not just financial insurance. It's not just a hedge. It's also about an investment return, And again, it's about owning it. You see, the people think, oh, well, I'm just an investor. I'm a sophisticated investor. Therefore, I'm going to buy the ETF because it's cheaper. But as we've shown in this podcast, it's not a whole lot cheaper, and you have a whole lot more risk.
Right.
So, and you're getting the benefit of both the insurance and the investment performance in terms of that performance, that return, and how it actually reduces the volatility in the overall portfolio and enhances the return.
Yeah, the sweet spot is not only to get a return, but to reduce the volatility of that return. That's the cost of that return over time. If you get something that can do that, and a really good financial advisor will do that in a portfolio, they'll optimize for return and volatility.
Okay, so the closer the proximity that I am to my gold, the
more optionality you
the
have.
more options that I have, the lower the risk, or the less risks that I have.
Keeps the dealer honest, keeps everybody aligned, and we're all on the same page. And it's just a much better, safer way of owning gold. And gold is a safe haven asset, but it's only a safe haven asset if you own it in the safest ways, with the safest counterparties and in the safest jurisdictions.
Yeah, and as we've learned today, not all gold is equal. All right, gents, I think that's a great spot for us to wrap up this episode of Goldnomics. I want to thank you both again. Thanks, Steve. Thanks, Mark. I have yet again learnt a huge amount from both of you, and I really appreciate it. And I say all of our listeners also have learnt a huge amount. And I just want to remind everybody to subscribe. We're putting out podcasts on a monthly basis. I want you to subscribe on either iTunes, on SoundCloud, on YouTube. We're trying to spread this as much as possible. If you have any comments on this podcast, or if you have any comments on topics that you'd like us to cover in the future, just put them into the comments section below the audio or below the video, and we'll do our best to follow up on those. But for now, once again, Steve, Mark, thank you very much.
Thanks a lot, Dave. Well done.
Thank you very much, everyone.
You're listening to the Goldnomics podcast, with new episodes every month on iTunes, YouTube, and SoundCloud. Subscribe to stay informed.